Life insurance, you probably think of it as a gift to your loved ones. But what if it could quietly sabotage your financial aid or government benefits without you ever knowing? Today, we're pulling back the curtain on one of personal finance's sneakiest landmines. And trust me, the rules are stranger than you think. Here's the setup. Needs-based programs like Medicaid, supplemental security income, and federal college aid through the FAFSA all look at what you own before deciding what you get. Think of it like a bouncer at a club. They're checking your wallet before they let you in. And certain life insurance policies are basically a VIP pass that gets you kicked out. The key villain here is something called cash value, which is the savings component that builds up inside permanent life insurance policies like whole life or universal life. If your policy has cash value, the government sees it not as protection, but as an asset, cold, hard, countable money sitting in your name. Term life insurance, on the other hand, is basically invisible to most of these programs because it has no cash value, it's pure death benefit, no savings, no tricks, no problem. So if you're holding a simple term policy and sweating over your FAFSA, you can exhale right now because term life is almost universally excluded from asset calculations. But the moment you step into permanent life insurance territory, the math gets uncomfortable real fast. For SSI, the Social Security Administration counts the cash surrender value of your policy as a resource. And if that value pushes you over $2,000 in total countable assets, your benefits get cut just like that. Medicaid follows a similar playbook, though the rules shift depending on which state you live in, how the policy is structured, and what the face value is. Some states exempt policies with a face value under $1,500, others use different thresholds, and a handful have their own creative interpretations that would make a tax attorney's head spin. Now let's talk college aid, because the FAFSA situation is actually one of the more pleasant surprises in this whole story. The federal formula does not count the cash value of life insurance policies as a parent or student asset, which is honestly a rare win in a system that seems designed to find every dollar you own. Here's where it gets ironic though. While the federal FAFSA ignores it, some private colleges using the CSS profile, that's the supplemental form for institutional aid, absolutely do ask about life insurance cash value and may factor it into their own calculations. So you could be fine at a state school and penalized at the private university across town, which is exactly the kind of absurdity personal finance was built on. People often assume that because life insurance is meant for protection, the government must treat it with some kind of dignity and respect, and that assumption has cost real families real money. The system doesn't care about your intentions, it cares about your balance sheet. The historical lesson here is that the families who navigate this best aren't the ones with the most coverage. They're the ones who understood what kind of coverage they had before a crisis forced the question. Structuring policies thoughtfully, keeping cash values low, or using irrevocable life insurance trusts, or simply leaning on term coverage during high-need years are all moves that savvy planners have used for decades. The actionable takeaway is this. If you're applying for needs-based benefits or filing the FAFSA, audit your life insurance policies right now and know exactly what's countable and what isn't. A little homework today could be the difference between qualifying for thousands in aid or watching it disappear because of a policy you forgot you even had. And philosophically, this whole situation is a reminder that in personal finance, the what matters just as much as the how much. One type of policy can be completely invisible to the government, while another of equal value quietly disqualifies you, and discipline means knowing the difference before it matters. The comfort here is that this is genuinely a solvable problem. Unlike market risk or job loss, this is a structural issue with structural solutions that don't require luck, just knowledge and a bit of planning. You can't always control outcomes, but you can absolutely control how your assets are positioned before anyone starts asking questions. Whether you're protecting a family, preserving benefits, or trying to maximize financial aid, the move is always the same. Understand the rules of the game you're already playing. The people who win aren't usually smarter, they just read the fine print before signing. And if you want help navigating these financial decisions alongside real estate investing, home contracting work, or finding the right lenders for your goals, check out our links in the description below.